Okay, so I'm recording this. So now I want, because we use the two questions, right? I hope you now you really know how to deal with the direct materials variance analysis and also direct labor variance analysis. So now let's move on, take a look at the variable overhead, right? So the production cost has three components: materials, labor, and overhead. So now let's take a look at the variable overhead, okay? So what do you know about the variable overhead, right? So you have learned about the actual cost. Again, it's on the left side, right? The actual cost always on the left side, right? And this time you can see there are four. Okay, there are four. But this one is called allocated budget. Okay, allocated. So what do you mean by allocated, right? Remember, for overhead, right? Over the time, you have to use a standard rate to allocate overhead to different product, different pool, right? If you remember that. So you have a budget rate. And often the case that this allocation is different from the actual, right? So then you compare this one, the left, and to the far right. When you compare these two, the difference is total variable overhead variance. You can either over apply it or under apply it. Okay, so when you apply this variable overhead, you can either under apply it or over apply it, right? And you remember, right? There's a video I show you how to do the journal entry, right? So that's the case. Okay, so that's this level when we are talking about using the actual number versus the allocated number. The difference is either over applied or under applied. Okay. Now, okay, flexible budget. This number, the way how you calculate this number, the flexible budget, is exactly the same. Okay, exactly the same as how you calculate this allocation. Okay. So therefore, these two numbers are the same. These two numbers are the same. So when you compare these two numbers, because they're the same, there is no variance. Okay, when you can see these two arrows, right? That means you are comparing these two numbers because they are equal, always equal. So therefore, there's no variance. The difference is zero. Okay. And then this is the middle column. We have already know, right? We have seen this actual input times budget rate. Okay. Again, when you compare the left to the middle, this is called a spending variance. Okay, spending variance. When you compare the middle to the flexible budget, this is the efficiency variance. Efficiency variance. And together, that's your flexible budget variance. Okay, so are we clear with this setup? Okay, good. Okay, so let's work on one question. Okay, so in this question, okay, so just give me 1 second. Do you guys like to do PowerPoint? Make a PowerPoint?
No.
No, okay. I don't like it either. It's a lot of work. Okay. So this is the question. You have four variance analysis. Okay. Company produce chemicals for large biotech companies. It has the following data for manufacturing overhead cost during the August. So one column is for variable. The other column is for fixed. So for this slide, we only focus on variable overhead. The actual 35,000. Allocation 33,900. Flexible budget 33,900. Remember, right? We talked about these two numbers are the same, right? For the variable overhead. The actual input times project rate. This is in the middle, 34,100. Okay, so let's work on this. First, the spending variance, rate variance for the variable overhead. How do you calculate that? And then efficiency variance. Okay, so I will show you. So the actual cost, this is always on the left, right? Actual cost is 35,000. And the flexible budget, okay? This one is 33,900. If I take this difference, what is the name of the variance I'm going to get between 1 and 3?
Rate variable. Okay.
So once again, sorry, I didn't hear you very well.
Rate variance.
Rate variance. If I use 1 minus 3, what is the name of the variance?
Flexible budget variance.
Okay, now I got you. Flexible budget variance. Okay, so when you compare your flexible budget versus the actual cost, this is your flexible budget variance. Okay, and the difference is 1,100. That cannot be right. That's not 1,100, right? Yes, that's 1,100. Yeah. So this one is unfavorable because the actual cost is higher. Okay, actual cost is 1,100 more, right? So that's unfavorable variance. Okay. Now I will add something in the middle, right? I'm going to add something in the middle. Which one I'm going to add?
Actual input and budgeted rate.
Very good. So I'm going to add this, right? Actual input and budget rate in the middle. You know, I found it's very strange. This animation didn't work really well. So I'm adding this in the middle. So that's the 34,100. Now, if I take the difference between 1 and 2, what do I get? Between 1 and 2.
Spending variance.
Yes, spending variance. What about between 2 and 3?
Efficiency variance.
Yeah, very good. So you can see the spending variance or the rate variance is 900 unfavorable, cost more. And the efficiency variance is also unfavorable. This one is higher than the budget. Okay. And last, allocated. So the actual versus allocated. What is that difference? 33,900. So actual
total variable overhead variance.
Yeah, total, right? Total variable overhead variance. And this is also the amount of over or under applied, right? Okay, so are we clear with this? This is the variable overhead. Okay, good. Now let's take a look at.
I have a quick question.
Go ahead.
Since the allocated and the flexible are the exact same thing, why we are talking them separately?
Because you're gonna see for fixed manufacturing overhead, that's a different story. Okay.
Oh, okay.
For variable overhead, they are the same. Okay. But for the
Okay.
fixed overhead, it's different. Yeah.
Okay.
Very,
Thank you.
very good question. Yeah. So now let's take a look at the fixed manufacturing overhead variance. Okay. So you can see that the actual cost is on the left side. This allocation allocated on the right, far right, right? In the middle, okay, in the middle, there are two columns. And this time is interesting, right? The flexible budget is the same as the middle one, right? We always use the actual input times budget rate, right? These two are the same. And in fact, that number is very simple. This number, you find it in the static budget. Okay, remember when you have the static budget, right? The fixed cost is fixed. Even though for the flexible budget, the fixed cost is still fixed. Remember in the beginning of the video, I just showed you at the beginning of the class, right? When we talk about the fixed cost, that number is the same, right? For the static budget and the flexible budget, 2,500. Do you remember that? Let me take a pull. Okay, if you remember what I'm talking about, in the very beginning, I showed the video, right? And then, you know, the fixed cost is 2,500, and it's the same 25 for the static budget and for the flexible budget. If you remember that, please sum up. Okay, wow. Oh, many of you are really paying good attention. Okay, so basically, because it's a fixed cost, right? Because it's a fixed cost, fixed manufacturing overhead, so the static budget and the flexible budget, okay, the fixed cost, manufacturing cost is the same. Okay, so that's why these two numbers, you don't have to calculate it, okay? So just find the static budget and find what's the fixed manufacturing overhead. These numbers are here, okay? And this one is a calculation, right? This one is a calculation. You first have to calculate the budget rate. How? You use this fixed number divided by the static activity level to figure out what's your budget rate. And then you times your actual input level, okay? That's how you calculate the allocation. When you compare the allocation with the actual cost, this is your total fixed overhead variance. It's either over-applied or under-applied, right? And, okay, and why? Okay, because these two are the same, right? So when you, honestly, this is, why it keep jumping? Okay, so here, these two, okay, they are the same, right? So when you compare these two numbers, never there's a variance, okay? So these two are the same. When you compare flexible budget versus your actual cost, these two gives you the flexible budget variance, right? And when you compare this left and the second to the left, that give you the spending variance, okay? And here, now you see, right? These two numbers are not, for the variable cost overhead, these two are the same, but not for the fixed cost, right? For the fixed cost, these two reflect the production volume variance. Why? Because this number is from the static budget, okay? So the rate is calculated based on the budget level of production, but this allocation is based on the actual output production. Therefore, the difference is due to the change in the production volume. So therefore, the difference here between these two are the production volume variance, okay? Are we clear with this picture? Do you have any questions on this? Oh, maybe it's too late. Your brain has already shut down.
So does that mean the spending variance is equal to flexible budget variance always in this case?
Yes, yes, good job.
Okay.
Anybody else have any question? If you understand this, please give me a sum up. 1, 2, 3. Okay, awesome. So I'm almost done. Just one more question here. We're going to finish this question. And I have to do this animation. It's actually taking me quite a bit of time to prepare these slides. Just because I was trying to make it more easier for you to understand. Okay, so now let's deal with the fixed. Let's deal with the fixed overhead variance. Okay, so we start from the left side. Okay, the left side is the actual cost, right? Actual cost, that's 18,200. And then the right side, that's the allocated amount, right? Allocated amount, that is allocated, that's 17,400. Okay. So what if I take the difference between these two? What variance do I get? Too easy? You don't want to answer me?
Is it
300
un-
unfavorable. Is that the total variable?
Yeah, total fixed overhead variance. Yeah, it's also called either it's under allocated or over allocated. Okay. And now let's see. I have actual cost and flexible budget. Okay. If I take these two difference, the flexible budget, that's this number, 17,900. That's given, the flexible budget. So if I take these two difference, what do I get? What's the name of the variance?
Flexible budget.
Yeah. So that's the flexible, right? This is flexible. So this between 1 and 3, this is the flexible. And between 3 and 4, that's the production volume variance. Okay. Now let's take a look at 1 and 2, right? So this one, right, the left column, the second to the left, 1, 2. Remember this one is equal to the flexible budget, right? Remember that. This and both numbers are from the static budget, right? The fixed cost. So these 2 and 3, they are equal, 17,900, 17,900. So when I take these two, what do I get?
Rate variance.
Rate variance, and there's another name, right?
Spending.
Spending.
Yeah, rate and spending. Yeah. Okay, so yeah, we are done. I'm because of the due to the time sake, right? I have no time to keep doing 825. But this one is a good question because it reviews chapter 7 and 8. So in this question, you're going to work on materials variance and labor variance, variable overhead, and fixed overhead variance. So you're going to do everything in one question. So I want you to work on this one. Okay. So make sure you try to do it by yourself and you can take a look at the answer, right? The answer has been posted. So make sure to do this, okay, in your own time. Before we leave, do you guys have any other questions?